Every generation is handed a script written by the society that came before them. Go to school, secure a stable corporate position, and sign your name to a 30-year mortgage. We are taught to look at a single-family house with a manicured lawn as the ultimate symbol of financial security. It is a beautiful, comforting tradition. But if you analyze the underlying mathematics, a primary residence is not an asset. It is a disguised liability. Month after month, it quietly consumes your capital through property taxes, interest payments, and endless maintenance costs. You are forced to trade your daily time for digital currency, simply to feed a structure that yields zero incoming cash flow. You don't own the home owns you. But look past the traditional consumer script, and you uncover a hidden counter strategy, a blueprint used by a quiet class of operators who transform shelter from a permanent expense into a self-funding wealth machine. Let's break down the exact mechanics of buying your first rental property. We will dissect the raw banking data required to qualify, the structural strategy of house hacking, and the mathematical formulas used to spot a genuinely profitable property hiding in plain sight on the open market. To understand how to control real estate, you must first understand how the banking system views your personal financial profile. Most beginners make the mistake of looking at real estate listings before they ever audit their own data. This is a critical error. Before a commercial institution will allow you to leverage their capital, you must meet two strict underwriter thresholds. First, your credit score must sit at 740 or higher. The mainstream world views a credit score as a metric of debt, but sophisticated investors view it as a weapon to lower the cost of capital. Falling below this threshold triggers a higher interest rate, which dilutes your monthly profit and limits the amount of property you can control. Second, the bank will demand a deep audit of your past 24 months of verified IRS tax returns. Lenders do not care about your current monthly trajectory or your future potential. They take the exact mathematical average of your net income over the last 2 years. If your income fluctuates wildly, or if you cannot provide clean proof of employment along with 2 to 6 months of liquid cash reserves, the machine will deny your application. Once your personal financial data is secure, you can begin analyzing actual properties. But the standard real estate market is a minefield. 95% of the properties listed on consumer websites do not make economic sense for an investor. They are priced for emotional retail buyers, not for cash-flowing systems. To survive, you must target the lower middle tier, the median price range of your specific local market. Avoid premium luxury estates because the operational expenses will suffocate your margins. Avoid high-maintenance condominiums because random homeowner association fees will quietly eat your profit before you ever collect a check. Instead, search for simple single-family homes or small multi-family structures that require light, cosmetic upgrades. Peeling paint, outdated kitchens, and neglected landscaping scare away the average emotional buyer. But to a systematic operator, cosmetic damage is an opportunity to manufacture immediate forced appreciation, increasing the value of the asset within 30 to 60 days. To separate a true cash-flowing asset from a structural money pit, professional investors rely on a strict calculator known as the 1% rule. This rule dictates that the total monthly gross rent generated by a property must equal at least 1% of the initial total purchase price. If a multi-unit property costs $300,000, it must command at least $3,000 a month in total tenant revenue to justify the transaction. If local market rents cannot meet this baseline threshold, the deal is mathematically dead, and a logical operator walks away immediately. Furthermore, you must account for the phantom expenses that quietly destroy amateur landlords. When calculating your real cash flow, you must subtract a permanent percentage for vacancies, property management, and structural capital expenditures, known as CapEx. Roof replacements, foundation settling, and major heating or cooling failures are mathematical certainty over a long enough timeline. A sophisticated operator automatically sets aside 10% of every single rent check into an untouchable, separate reserve account specifically for these infrastructure updates. If you fail to build this operational reserve fund directly into your ledger, a single broken plumbing line will completely wipe out an entire year of rental profit. Now, the primary barrier for most prospective landlords is the traditional 20% down payment. On a $400,000 property, coming up with $80,000 in physical cash can stall an operator for years. To bypass this capital bottleneck, professional real estate investors utilize a structural loophole known as house hacking. Instead of purchasing a property as a pure investor, you acquire a 2 to 4 unit multifamily building, like a duplex or a fourplex, under an owner-occupied framework. By leveraging federal programs like an FHA loan, the statutory down payment requirement drops from 20% down to just 3.5%. The legal rule is simple. You must commit to living in one of the units as your primary residence for a minimum of 12 months. While you reside in your unit, you lease the remaining neighboring units to traditional tenants. The incoming rental income from those units goes directly toward covering your property taxes, your insurance, and your underlying mortgage principal. In a properly calculated deal, your tenants completely liquidate your monthly housing expense. You are suddenly living for free, while your tenants systematically build your equity month after month. After the 12-month residency requirement expires, you can legally move out, convert your former unit into a final rental space, and repeat the exact same process with a new property. Within a decade, this repetitive framework constructs a compounding portfolio of cash-flowing units, entirely funded by the open market. Look at how the entire macroeconomic loop connects. You optimize your personal credit and tax data to lower the cost of capital. You bypass massive cash requirements by leveraging owner-occupied financing loopholes. You target undervalued as cosmetic assets to force immediate appreciation. And you use tenant cash flow to eliminate your largest daily expense, shelter. The corporate media will tell you to keep participating in the volatile swings of speculative markets. They will tell you to trust your future to digital paper assets that can fluctuate based on a single headline. But true sovereignty is never found inside an unstable digital hallucination. It belongs to those who look past the noise, to control real, physical infrastructure. The machine never stops printing debt, but you can stop believing in it. If you want deep, data-driven insights into how business, value investing, and macroeconomics actually operate, subscribe to this channel right now. Turn on notifications, and share this breakdown with someone who wants to understand the real systems behind wealth creation. I will see you in the next breakdown.